Hello, I'm Craig Brailsford. Welcome to another episode of Small Stocks, Big Money. For those of you new to the show, RedChip is an investor relations, media, and research firm focused on emerging growth companies. Our unique platform combines global multimedia with traditional investor relations, reaching investors around the world. Now, today's show features interviews with the executives of two companies. First up is an interview with JD Hatfield. JD Hatfield is a founder, CEO, and portfolio manager. Mr. Hatfield has almost 3 decades of experience in the securities and investment industries. At Infrastructure Capital Advisors, he is the portfolio manager of the InfraCap Small Cap Income Fund, SCAP, on the New York Stock Exchange. He leads the investment team and directs the company's business development. We'll learn more when we speak with Jay later in the show. Up next is 60 Degrees Pharmaceuticals. 60 Degrees Pharmaceuticals is a growth-oriented biotechnology company developing new therapies for vector-borne diseases. The company markets the FDA-approved anti-malarial Arakota, also known as tafenoquine, and it is advancing tafenoquine into new indications, among them babesiosis, a tick-borne infection with no approved treatments. We'll learn more when we speak with the CEO later in the show. Before we move forward, let's take a look at RedChat, a revolutionary AI chatbot for small-cap stock analysis.
A new era of small-cap research has arrived with RedChip's RedChat, the fastest, most accurate AI assistant for small caps. The days of spending hours sifting through press releases, 10Ks, 10Qs, 8Ks, 13Fs, 13Gs, and other filings is over. Now, get answers in seconds on 4,000 small-cap stocks in one portal. Simple, fast, accurate, detailed answers. Meet small caps with RedChat.
Now, let's move on to our quote of the week. It comes from the book, Small Stocks, Big Money. Invest in something you can get your arms around and be very conservative. Own enough stock so that you are not putting all your eggs in one basket. This quote comes from Dave Maley of Ariel Discovery Fund, and it is featured in Chapter 5 of Small Stocks, Big Money, a book of exclusive interviews with some of the biggest players in the microcap space. Get a digital copy on Amazon today for just $21. Now, let's get started with our first interview today with JD Hatfield. Hello, today we are pleased to have in our studio JD Hatfield. He's the founder, CEO, and portfolio manager of SCAP. Jay, great to have you today.
Thanks, Craig. Great to be on.
Jay, we were talking off camera before this interview. Great to get to know you. You worked as an investment banker, hedge fund portfolio manager at SAC Capital. You co-founded a publicly traded master limited partnership. How does this multidisciplinary background shape your approach?
Well, of course, the core training was being at hedge funds and learning to be a great analyst. And so that's really the core of what we do. We make our own projections, particularly for small caps because they're not covered well. So they need firms like you to get more coverage and get more people interested. So we can add a lot of value on the buy side by doing our own projections. I was a CPA. That makes you really good at doing projections. And really all those professions, investment bankers do projections, do valuation. And then the last thing is, because I've advised corporations and started one, you also have a better feel for the decision-making going on at the corporation. So if there's any corporate actions, you understand how long it might take, what the decisions they're making. So it can give you good insight to not just grow up solely being on the buy side and never working closely with corporations.
Tell us about SCAP, the income fund that you manage.
Yes, so we're excited about the fund. We launched it about 2 years ago, and it's very hard to get funds that are conservatively invested in small caps. So we only invest in profitable companies that pay dividends. We do have preferred stocks. We do a small amount of call writing as well, index and individual calls. And so we're able to deliver over a 7% yield, which is highly unique. So you get the upside of small caps, but also get to collect income with more conservative companies that really stacks the deck in your favor. So if you hold it over long periods of time, you're likely to get good returns.
Jay, you were talking about your flagship, PFFA. Tell us about it. Why are preferred securities so important?
Well, what's really interesting about it is that they are fixed income securities. So the volatility would be way less than regular equities, way less than our S-cap fund or any small cap companies. So like about 5, most stocks are about 20% volatility, but yet you get really good yields over 9%. And usually with fixed income, the yield is often your return. So instead of a lot of fixed income, you get 4%, here you get 9. And preferred securities are issued by public companies. They care about their credit, and therefore they have low default rates. They'll issue equity, cut the common dividend, sell assets to maintain credit quality. So we think they're far better credits than private companies. So everybody's excited about private credit, but you can get defaults there and fraud, which is very unlikely with public companies. So we think it's an attractive asset class. It should work well in this market where you're likely to have lower rates, but also a strong stock market. So spreads tighten and you get good total returns.
And how do you define a small cap stock for the purposes of your funds?
For S-cap, it's everything below 10 billion.
10 billion.
You tend to get with the larger cap companies, you tend to get a little bit higher quality, but sometimes there's better opportunities, more undervalued companies in the smaller cap range. So we do look through the whole universe. But right now, obviously our larger holdings tend to be larger caps, like closer to that 10 billion.
All right, so we defined your general range for market cap. Well, what are some other key metrics that you prioritize when you're looking at funds for your inclusion?
Well, particularly with small caps, it's absolutely critical to make sure the companies are profitable. So what most investors don't appreciate is if you just hold a diversified portfolio of profitable companies that are reinvesting a good portion of those profits, you will do well over time because companies are usually investing at about 15% after-tax returns. If they retain 70, you get 10% growth. But if you invest in unprofitable companies, you sort of get the reverse metric. So it's a little bit of the question, do you want to be the casino or go to the casino? If you are the casino with profitable companies, you get your 10%. If you have loss-making companies, which there's a lot of small caps, then the casino is taking 10% out of the pot.
Now, Jay, you've been on both sides in your long career. You've been capital raiser and allocator. I'm very interested in hearing. What are the red flags that pop out to you when it comes to these small cap companies?
Well, I'd reiterate what I said about profitable companies. So when I was an investment banker, this is in the 90s, so it was a while ago, we wouldn't take companies, there's a Morgan Stanley pretty high quality fund. We wouldn't take companies public. They were unprofitable for exactly the reason I mentioned. Is it didn't have to be forever, but at least one quarter. Because if you haven't proven that you can be profitable, you may never be profitable. So that's the primary risk. We do tend to deal with slightly larger companies because they tend to have been around longer, less likely to have like accounting problems. But, and then the other thing that's more subtle, but we don't want to overpay for companies. So a lot of times, particularly retail investors will just say, oh, well, this stock's going higher and higher and higher. It's got great momentum. And they never look at the valuations. And not to pick on it, it's not a small cap, but Palantir was trading at a 7 PEG ratio. So P to growth, markets at 2. Now stock's off 30 or 40%. Well, you could have stayed out of trouble by just saying, well, look, too rich for me. If it's going up every day, God bless you. So I'd say overvaluation. It's probably almost more, I mean, it's kind of a little bit similar to being unprofitable. But if you stay out of overvalued companies, you won't get annihilated. And a lot of this of investing is just holding a good portfolio of companies for long periods of time and avoiding the blowups. So if the company's not overvalued, we use PEG-E or PEG-E ratios. We include yield if it has high yield. And just don't overpay P-wise relative to growth plus yield.
Do you deal with foreign companies?
You know, we don't, not because we necessarily think they're overvalued or bad companies, but we try to be focused. The U.S. is the best capital market in the world, has the best disclosure, best access to information, and we don't want to spread ourselves too thin. So we're almost, and then might own a Canadian company, but 100% focused on North America.
Small caps underperformed so much in recent years. Do you see the tide turning?
Absolutely. So obviously, small caps are riskier companies. And since the pandemic, because of the change in the use of technology, large cap technology companies became safe havens, which is unusual but true in this cycle. And so small caps were banned and often shorted by hedge funds so they could invest market neutral in check. And what really was the signal to get into small caps was when the Fed chair, who's pretty hawkish on average, became dovish in August. And that was really the absolute moment in time that small caps started outperforming. They're more diversified, they have less tech, but also you can access this on our website. They trade at much lower, I was talking about PEG ratios, much lower PEG ratios, about 1, market's about 1.8. So they're very compelling from a valuation perspective, the growth to the PE. And then also you can just look, it's sort of bad news they've underperformed, but good news, that's what drove that valuation. And if you look longer term though, small caps are an attractive asset class. You just don't want to own them during a down cycle. And in fact, we've been in a down cycle since the pandemic started.
And what is that website?
Infracapfunds.com.
All right, I'm going to put you on the spot here, Jay. One macro variable, if there was one macro variable that investors should be looking out for in the next 12 months, let's say, what would it be?
Absolutely inflation as measured by PC core, which is what the Fed follows. So we have a very bullish stance in the market. We have an 8,000 target, and we think rates are going to 375 on the 10-year. But to get there, we need those 3 cuts that are, well, it's actually 2 cuts. We're forecasting 3. And for that to happen, it can't just be the Fed chair jamming it, the new Fed chair. It's going to need to have some decline in inflation. But if you look at the pattern, last year in February, we had a huge 0.5 print. And so we think that's going to roll down in February. We'll get that data in March. And that'll be a catalyst for the market to get us going, because we're kind of stalled out a little bit with this tech turn down. A catalyst to get us moving towards that 8,000, because lower rates is just fuel on the fire for stocks.
And especially small cap.
Absolutely.
Right.
You need the Fed rate cuts to keep small caps. They're doing really well, but keep them moving. And so the inflation is the key driver of the Fed, which is the key driver of small caps.
Great meeting you, Jay. Thanks for coming by.
Thanks, Greg. It's great to be on.
Now, to get more information on infrastructure capital advisors, visit infracapfunds.com. You can also call 1-800-RED-CHIP to speak to a specialist if you have any questions. And we also have a free weekly newsletter you can subscribe to at redchip.com featuring emerging growth companies. Watch this show again and explore hundreds of small cap stock videos on RedChip's YouTube channel. Also, go to our website and sign up on our events page for the webinar series. We have webinars every week, several a week, in which we feature small public companies, mostly our client companies. And you'll hear straight from the CEO, and you'll be able to ask questions after that. Again, visit redchip.com and subscribe today. In addition to our newsletter, you can also order your copy of Small Stocks, Big Money, a book written by RedChip's CEO featuring interviews with some of the biggest players in the microcap space. Order your copy on Amazon today for just $21. Now, let's move on to our next interview today with 60 Degrees Pharmaceuticals. Hello, today we have the pleasure of welcoming back Jeff Dow, the CEO, President, and Director of 60 Degrees Pharma. Jeff, hello again.
Hey, Craig, it's great to see you again.
For those investors who may be discovering this company for the first time, Jeff, how would you describe what 60 Degrees Pharmaceuticals does today, and why is its focus on vector-borne diseases creating a compelling long-term opportunity?
Well, of course, vector-borne diseases can be acute. You get really sick like the flu, but that they can trigger these really long-term nasty conditions, and there's no FDA-approved treatments to manage them. So we see an opportunity there to address short and long-term needs, and no other pharma companies really in the space doing it.
Arakota, it's FDA approved, commercially available, and differentiated with weekly dosing and activity across all malaria life cycle stages, Jeff. You've recently announced partnerships with GoodRx and a travel focused telehealth channel. You've also outlined plans to expand the inside sales team and increase digital marketing in 2026. How should investors think about the revenue impact of these initiatives?
Well, Craig, you nicely outlined the product profile of Aricoda in your introduction. The problem is that people don't know about it yet. So part of the initiative you described with GoodRx is to capitalize on their universal brand recognition to put the message out about Aricoda. And of course, telehealth and online platforms are kind of the trend in the way that pharma companies are interacting with patients directly. And our partner, Runway Health, is the first entrant into this field in travel medicine. And so we're exploring with them what that novel channel might mean for this particular business. And then, of course, finally, from the 2025 pilot, we know that our reps can increase sales of or prescriptions of Aricoda where there's good brand awareness. And so that's why we're increasing the headcount in 2026.
Babesiosis. It's a name maybe a lot of people won't immediately recognize. It is, however, a growing tick-borne disease with no FDA approved treatments today. However, I remember you teaching us that babesiosis, in many chemical ways, looks like malaria. You can maybe elaborate on that. You've got tafenoquine, you've got Aricoda, which is tafenoquine. How does tafenoquine have the potential to become the first in class therapy for babesiosis?
So, of course, babesiosis has an acute disease form, which is very like malaria. It causes the same sort of symptoms. It invades red blood cells, and so it causes anemia like malaria does. But unlike malaria, babesiosis is triggered or perhaps can be associated with a long term, more chronic disease, a little bit like Lyme disease or long COVID. And that particular manifestation of the disease uh, has been poorly studied, and there are no available therapeutics to treat it. Aricoda, we know from the scientific literature, kills Babesia organisms. We know from case studies that in relapsing disease, that it provides clinical benefit in a small case series. And we know that it's weekly dosed and well studied in terms of safety for up to 12 months. And so that unique combination of features would be ideal to treat a chronic form of babesiosis. And that's what we hope to be going after with the clinical trials that we're doing.
Now, among tick-borne diseases, babesiosis may not be as infamous as Lyme disease, but it is big. Your management team has estimated that there are up to 380,000 addressable patients in the United States annually and up to $245 million in potential peak sales. How does that market, the babesiosis market, compare to your current malaria business?
So 10 years from now at peak sales, we think it could be at least 3 or 4 times bigger than the malaria business. And I just reinforced that that set of numbers you quoted was our initial estimate, and it'll get refined over time as we get more information about the market and the willingness to pay and prescribe over time.
Now, you're different from small biotechs in many ways, and one of them is the way you've emphasized capital efficiency, Jeff. You've leveraged an existing commercial infrastructure. You've got an FDA approved drug right now to support pipeline expansion, your imaginative attempt into babesiosis. Very impressive. Now, how does that strategy preserve shareholder value?
So I guess the first thing is we're revenue generating. And so there's a timeline between now and when we get to commercial profitability with our existing indication. And of course, that's great for investors because now we don't have to dilute the shareholder base anymore to raise capital because we have to. And the other thing it is advantageous for is that it kind of locks you into a narrower strategy to expand the therapeutic case, because it makes sense to capitalize on the existing known information, which is primarily around the dosing regimen and safety. So we have chosen to target new indications where that existing chemical and manufacturing process, the dosing regimen, and the safety all line up to minimize cost and risk.
What milestones should investors be expecting in the next year or year and a half?
So, of course, we have 3 babesiosis clinical trials which are underway at the moment. We should see data for one of those trials come out in the second half of the year. And then that, together with the supporting data from the other trials, will enable us to craft a regulatory strategy moving forward. Of course, that could go in many different directions, so we haven't been too public about what strategy we think makes sense. We hope to provide more information about that towards the end of the year. And then, of course, the other piece is we are revenue generating. We're doing some innovative things, like you mentioned, with Runway Health and GoodRx, to try and expand sales for malaria. And those efforts should start to yield some data points and trends towards the end of the year, which we can communicate with investors.
All right, Jeff, speak directly to our viewers here. Tell them, what is the essential value proposition? Why should anyone take an interest in 60 Degrees Pharma right now?
You know, it's kind of frustrating, right? We've got a very small market valuation, but we have an FDA-approved product that's very close to being in a position to go to the FDA again to expand the label. We are generating revenue. We've got levers to pull to get to profitability. So what are investors waiting for? And that's my message to new folks who haven't interacted with the company before.
Expanding that label from just malaria to malaria and babesiosis. Best wishes on that, Jeff, and great as always to see you.
Awesome. Thanks for the encouragement, and see you next time.
Now, to get more information on 60 Degrees Pharmaceuticals, visit sxtpinfo.com. You'll see research reports, fact sheets, presentations, and the latest videos. It's all free, and you can even subscribe to email alerts to stay on top of the latest news. You can also call 1-800-RedChip to speak to a specialist if you have any questions. We also have a free weekly newsletter you can subscribe to at redchip.com, featuring emerging growth companies like 60 Degrees Pharmaceuticals. Watch this show again and explore hundreds of small-cap stock videos on RedChip's YouTube channel. Also, go to our website and sign up on our events page for the webinar series. We have webinars every week, several a week, in which we feature small public companies, mostly our client companies, and you'll hear straight from the CEO, and you'll be able to ask questions after that. Again, visit redchip.com and subscribe today. In addition to our newsletter, you can also order your copy of Small Stocks, Big Money, a book written by RedChip's CEO, featuring interviews with some of the biggest players in the microcap space. Order your copy on Amazon today for just $21. Now, let's recap the companies we featured today. First, you met JD Hatfield. JD Hatfield is a founder, CEO, and portfolio manager. Mr. Hatfield has almost 3 decades of experience in the securities and investment industries. At Infrastructure Capital Advisors, he is the portfolio manager of InfraCap Small Cap Income Fund, which trades on the New York Stock Exchange under the ticker SCAP. He leads the investment team and directs the company's business development. Learn more at infracapfunds.com. Then you met 60 Degrees Pharmaceuticals, SXTP on the NASDAQ. 60 Degrees Pharmaceuticals is a growth-oriented biotechnology company developing new therapies for vector-borne diseases. The company markets the FDA-approved anti-malarial Arakota, also known as tafenoquine, and is advancing tafenoquine into new indications, among them babesiosis, a tick-borne infection with no approved treatments. Learn more at sxtpinfo.com. Don't forget to check out our stocks page. It is the biggest small-cap stock portal in the industry. It has every company listed on the NASDAQ or New York Stock Exchange with market caps of $2 billion and less. And it's categorized by industry. Watch this show again and explore hundreds of small-cap stock videos on RedChip's YouTube channel. And be sure to sign up for our weekly newsletter and learn about a lot of small-cap companies. Also, go to our website and sign up on our events page for the webinar series. We have webinars every week, several a week, in which we feature small public companies, mostly client companies, and you'll hear straight from the CEO, and you'll be able to ask questions after that. Again, if you have any questions about any of our public companies featured on today's show, call us at 1-800-RedChip or email us at info@redchip.com. In closing, remember, while small-cap stocks can provide significant gains, you must be prepared for the downside. Small-cap stocks are among the most volatile of asset classes. Some of the companies featured on this show are RedChip client companies, and we may own stock in these companies. So please, always read our disclosures at redchip.com. Thanks for being with us today. We'll see you next week with some new, exciting emerging growth companies.